Welcome back, everybody, to Markonomics 101 presents Hoot Loot, the show where you come to be informed, amused, but never misled. Today is called Money, 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 like the Beatles song. That's the best things in life are free, but you can leave them to the birds and bees. Now give me money. That's what I want. Now you're looking at a chart right over my shoulder right here that is going to tell you more than you're ever going to want to know, and it's going to really tell you how dramatic the situation is right now, and that's why we're going to talk about it first. This is a chart of the U.S. money supply, M1, as it's called by the Federal Reserve. Now, what you'll notice here is the money supply has exploded 4 times higher in the year 2020. That's all those stimulus checks, all that deficit spending, all this stuff that's driving up interest rates right here on this chart. And if you do not know that it is this bad, this is going to set the stage for everything that's coming up. I want to thank everybody though for subscribing. We're getting lots of new subscribers. We love you, and we are trying to tell you everything you need to know in as little time as we possibly can, so you're prepared not to lose money, because we know that's what you want. That's what I want too, and we want more subscribers, and we want to see it. We're going to see it right back in a minute with the charts. Welcome back. We're going to go to the charts, but what I wanted to just make sure that you understood about the last one and why it was so important is that that amount of increase in the money supply has happened in 1 year. That is a precursor to something called hyperinflation, and that is something that is a train coming down the tracks right now that if you do not become aware of it and what the implications are, it's going to cost you. And we're going to try to keep that from happening, okay? So let's go to the regular charts now, and I'm going to show you exactly what's going on there. The Dow Jones Industrial Average still looking actually stronger than I expected, partly because all this money is being created and is going into speculation. And the fact that it's going into speculation is going to end badly. It's going to end really badly. Because at the end of the day, when you start distorting the economy like that, you start distorting free market economics, nothing good ever results from it. So let's go on to the next one. Now, this is, again, 2-hour intervals of the Dow. The reason I pointed this out, and the reason I did this, is to show you that at the bottom of the chart, we had a rally, a really sharp rally at the end of the week, but look at the volume. The volume is declining. What that means is that you're seeing like all kinds of like gyrations in amplitude, but you're seeing that last one straight up spike on no volume. Okay, so in other words, you don't have any real buyers, maybe only people covering shorts. I mean, that's about it. And so this is happening with no conviction, and that's an important sign to keep in mind, that eventually you can put so much money in the market, but it's going to have a marginal benefit that is going to be consistently reducing. So it'll take more and more of it to cause less and less effect, and that's what's happening today. As a matter of fact, deficit spending does the same thing. You have bigger deficits, they create almost no extra GDP, and it is absolutely a disaster on the fiscal level, but we'll talk about that another time. NASDAQ 100 still looks like crap, still looks terrible. This thing, I believe, is what is actually accurately leading the market lower. And what you see here is that it broke out of this little trend channel, and it is made highs below highs, lows below lows. That's called a downtrend. That's called bad, and these companies are humongously overvalued, and so it's just a matter of time before they come whistling down, and they're not going to stay up here for very long. That's the one thing. You're not going to have a whole lot of time if you want to get out of these things, okay? You're just not. Before you know it, they're going to be gone like that. You'll have had a moment in time where you could have gotten out, and you'll be kicking yourself the whole rest of the way. Trust me, I know. I've done it a million times. My butt still hurts from kicking myself. Okay, so let's go on to the S&P 500. It's now looking not as good either. It's also looking like it's making a rounded top. It's rallied on declining volume also. So the volume is something I normally don't talk about very much, but here it just stuck out that these indexes are actually, they're just kind of drifting back higher with really very little buying pressure. And so that means that this is likely to terminate really fast. I don't know exactly when, but it's going to terminate in very likelihood very fast. So The small cap index continues to just run like crazy, but again, declining volume. What it means is that either people are short covering, they're covering their shorts, but the buying power is not there. The selling people don't want to sell either because they're thinking, oh, what the hell, go up forever. So no one's buying, no one's selling. The thing is just kind of drifting, and at some point, some shock will occur, like, oh, I don't know, maybe interest rates going up. Yeah, that kind of thing. Okay, so the Dow Jones Transportation Average is a very important average. And again, I am still somewhat baffled by why this thing goes higher, because transportation is a cost of everything. It's included in every good. And so as transportation costs go up, gas prices going up, for this thing to be going up right here is really somewhat of a mystery, but we'll unfold that one. It's still in a negative pattern though. We're going to go on to inflation, and that's really sort of the theme of this show. Money, too much of it, too much creation of it, and why and how it shows up and how it affects people. Okay, this is a Commodity Research Bureau basket of commodities. This thing is going through the roof, and this thing is going up so fast, 100% almost in a year, that I would think somebody would kind of pay attention to this at our good friends at the Federal Reserve, who I expect to be talking to maybe later. We'll see. All right, now crude oil is one of the big reasons why, and crude oil continues to just soar every single day, soar. And the PPI, the Producer Price Index, came out this week. Okay, now the Producer Price Index comes out at 0.5% for the month of February. Now, the month of February, that means if you annualize it, that's 6%, okay? So we're talking about 6% inflation rate in wholesale goods. But the way the Fed reports it, and the way most people, the way they prefer to report it is the core, they call it the core producer price index, which is excluding things like food and energy, things that none of us use. I mean, I don't use any food. I don't use any energy for anything. And we don't have any transportation costs, and and rents don't go up too, because there's no rent increases at 10% a year, as we've seen in a lot of cities. So we have a nice little basket of commodities, including peanut butter sandwiches and bananas, and those are up to 2.5% a year. That's core producer prices for you. Okay, so unleaded gasoline continues to go straight up. Again, no one drives, I know. No one uses this, I know. But again, so this is going up a lot, and it's going up daily. And you cannot not feel the effects of this throughout the economy and the prices of goods. Now, the U.S. dollar, this is everything right here. The U.S. dollar, everything's denominated in dollars. Everything is about interest rates in dollars. Okay, money, money, money. That's why the show is called Money, Money, Money today. So it's all about money. The U.S. dollar is our version, is the U.S. version of money. It's strengthening. Why? Probably because our interest rates are slightly higher than elsewhere. We can get a better return from dollar-denominated bonds, 2%, whoop-de-doo, instead of, minus 0.5 in Germany or something like that. And I just, that's attractive on a relative basis. But when you look at how much money you lose every year in inflation and how much it eats up, it's not that attractive. So we're always going to keep an eye on the dollar. But we're going to do better than that. We're actually going to create our own currency. This is called Hoot Loot. The show's called Hoot Loot. And this is actually one loot, or one hoot right here. And the beautiful owl here. This is backed by the full faith and credit of Markonomics 101 and Hoot Loot. And this is going to stimulate the economy every bit as much as all those phony dollars that the Fed has created, okay? Except this is prettier, and this is nicer, and we're going to have these in ample supply for everybody, so the economy is just as stimulated by us as it is by the Federal Reserve. Okay, 5-year Treasury yields are going through the roof. Now we're starting to see shorter term rates go up. That's not good, because it means it's putting the Fed behind the box. They got to raise them pretty soon, and they don't want to do that. They want to be very dovish about inflation and everything else, and they want to make sure that the economy really recovers. Okay, all right. Yield on 10-year treasuries soaring. Look at that. Again, huge move on Friday. Huge move on Friday. As a matter of fact, if you look at this right here, this is an ETF of 7 to 10-year treasuries. Look at how much they plunged. So that move from like 50 basis points to 160 in 10 years, that has caused a 10% capital loss. Okay, so you get your 0.5% coupon, you get your 10% capital loss, and this is in the safe US 10-year Treasury. Oh, good. How safe is that? All right. So, and the 30-year, look at that. Another explosion in the rate. Why? Because someone came out. Oh, there we are. Oh, God. Okay. All right. You asked for it. Jay, how are you? I was just talking about you. As a matter of fact, have you looked at the M1 money supply lately and how much that has gone up? You haven't. Well, you might want to do that. You might want to watch the show because actually, I think there's a little more inflation than you're aware of. 2.5. What you're saying? 2.2%. X food and energy. Right. Well, no one eats. No one eats, and no one drives. Right. Okay. Well, good. I know we know that. We'll talk a little later. But why don't you watch the show and then you'll get an idea of what's going on out there. Okay. Say hi to Janet for me. All right. Well, anyway, Jay Powell, still kind of behind the 8 ball and living in a world of tame inflation. It's never going to happen because it hasn't happened in so long. Well, maybe we're due. So 30 years exploded. And here's the amazing thing. While the 30 years exploded in yield, the yield on the 30-year, you lost in 1 day holding this ETF, which holds 20 plus year treasuries, you lost 3% in 1 day. Why not own Microsoft lose 3% in 1 day? You won't even lose that in Microsoft. These are supposed to be safe. They're not as safe as you think because of what we call duration risk, or the risk of interest rates going up and affecting the capital price of the bond. The worst part about this is that they're still only at 2.5%, and the fact of the matter is that's historically incredibly low. They could easily triple from here, and if inflation really does start, soaring to levels of 5, 6, 7, or maybe even a lot higher than that, so it could happen. We're gonna have a lot of capital losses in bonds, and people are not going to be aware of it because, who's going to tell you that except hoot loot? Be informed, be amused, but never be misled. Not on this show. Okay, so these are the ProShares ultra short 20-year plus treasuries. A great hedge, a great spec, really, if you think about it. I would say this, that it belongs if you have an exposure to interest rates that you cannot control. This would be the best way to do it right off the bat because you have something that goes up with higher rates, and even though it's looking parabolic, it's still cheap. And the fact that it's still cheap at 2.5% historically says that timing isn't that important. You can get into this, and even if it retraces a bit, which it might, it's still going straight up. This thing has just momentum behind it like you can't believe. All those Reddit rebels ought to be chasing this up instead of the stuff they're doing. But that's a whole nother story. Okay, gold is also one of my biggest disappointments. As a matter of fact, is a perma bull in gold, which I kind of am. I'm very upset by the fact that gold hasn't performed. And, again, I wonder why this hasn't performed. It's possible that that's a function of the Federal Reserve, because Paul Volcker, who was the chairman when gold last had a huge run and an explosion, he said that the worst mistake he ever made was letting gold run because gold is a sign of a weak financial market. There may be a lot of truth to that, but gold will have its day. Even the Fed can't control it. They can't control everything all the time, no matter how much they try. Silver is looking better than gold, but probably also still got some pressure on it. The miners, which I'm going to show you now here, are also not looking so good, and that's a great disappointment to me because I know at some point these are going to be great buys, but they'll be much cheaper. So if you get liquid here, you're going to be able to buy some of these on the cheap at some point. And that's a better place to be than to be riding down the escalator with everybody else going, oh my God, I'm losing all my money. All right. Apple. Now, the reason we put stocks like Apple up here is because these are the high-tech, big, mega cap stocks that really move the market and accept the most money flows in and out. They have to. Apple is the poster child. I've said this before. I don't mean to be repetitive, but we get new viewers, and this stat still amazes me. Apple, at its peak, was worth $2.4 trillion, and that's bigger than all but 7 countries' GDP. Yes, all but 7 countries' GDP. Okay, so that's what I call a mania. And Apple broke down really fast. It broke down the soonest, and it was the first warning sign that there was trouble up ahead. So we're keeping an eye on this thing, but it may have a long way to go down no matter what, simply because interest rates are going up and the multiples have to come down. And it's so big, how fast can it grow? I mean, it's done a great job, but it's one thing in a 2% environment, it's another thing in an 8% environment. An 8% environment, this thing is worth about a third, okay? Amazon too. It's broken down. It's done pretty well. It's not really plummeting or anything like that. Sales continue to be good. Growth continues to be good. But interest rates continue to go up. And they're competitive with Amazon because it trades at a high multiple. And so the reason a lot of these companies are going down is not just because, there's a bad news is coming necessarily. It may not. But what's happening is if you're a high multiple stock, you're now competing with bond yields that are going up. And they're going to go up a lot more. And so your multiples are going to get scrunched. And that's what's happening here. No one wants to think that, but that's what's happening. Pure and simple. Facebook too. Relatively good pattern, relatively good. It's holding up pretty well. I said, I put here in danger of turning bearish. It's also in danger, or it could turn bullish too. It's in a negative pattern. It's only sin at the moment that I'm aware of, other than their fact checkers, and that is a sin. But other than that, their only sin is the fact that they're a high multiple company and that they censor everything that you say and do and all that. That's the only sin I can think of. So I'll let them get away with that. Okay. Google is a great pattern. It's in a healthy uptrend. I drew an island box a little while ago. I haven't changed it for a reason because I kind of wanted you to see what happens over time. We draw charts and sometimes they go out of the box. Sometimes they behave exactly the way you predict. But it is still in an island. And an island is really a very difficult thing. If there's a gap lower for any reason, all those people in that island, you see in that box and plus to the right of it, they're trapped at a loss. And all of a sudden you have a cascading situation of a bunch of people trapped at a loss that now cannot get out at anything but a loss. And it's a question of where they choose to get out and how much of a loss they choose to take. So this is one that could happen that way, but it's ultimately still in a pretty good trend right now. So I can't say that this thing is breaking down yet. Microsoft, same thing. Could be in a rounded top, could be breaking down, probably is though. Probably all of these are. And I'm saying probably because of the higher rates. And you have to, again, go with the odds of the situation. The odds are rates are going to trump everything. The dollar's going to trump everything. Okay, so it's not a matter of how good of a company you are in an environment where rates are going up. An environment where rates are going up, it doesn't matter. That's the most important variable. And when you see money supply going up like you did at the beginning of the show, okay, when you see it exploding, oh my God, you're really looking at the potential for a lot of interest rates, and they're still talking more stimulus. So, we're really facing a potentially harmful situation to the financial markets, but I don't want to get too dramatic here about it yet. NVIDIA, here's a semiconductor company. I've mentioned it before. This one has broken down. It's rallying back a little bit. We'll see. The NASDAQ is weak. All of the companies are going to have somewhat similar patterns. And it's all about, again, these are high multiple growth companies, okay? Same with Qualcomm, except Qualcomm actually looks like it's starting on a real good downtrend here. You're seeing highs below highs, below highs, below highs, lows, below lows, below lows. That is a downtrend. That's not good. Qualcomm is definitely a company to be reckoned with. It's not quite in the top 5, but it's in the sort of the second 5. And here's my favorite second 5 company, Tesla. Tesla has already gone down 30% from high to low, and I'll bet a lot of people that loved it are going, oh my God! And this thing I think it's rallied back a little bit, rallied actually quite a bit, rallied 100 points the other day, but it hasn't rallied to a new high. It's still got highs below highs, lows below lows, and the bet would be that this continues to make lower lows and has a lot lower to go. Tesla still is a fantasy company, but it's an incredibly good indicator of the sentiment of the most speculative money out there. And this shows you right here, they're running out of steam. The bank index, the banks continue to soar. Simple as that. That's why the market really is not quite there yet. You know, it will be, but there's actually more pluses, you know, from Wednesday than there are minuses this time. But except interest rates. And interest rates are more important than all those things because all those things are more likely to be just snapbacks a little bit. Interest rates are where it's at. And the bank index continues to do well. Nothing more to be said about that. I could show you all the banks that are in parabolic curves. I'll show you a couple of them. Broker dealer index continues to soar also. These are the guys that make you broker by giving you bad deals. And that's what I like to say. You know, I like my favorite, DoorDash. You know, anyway, biotech, come jab yourself. These are actually going down, very surprisingly so. I don't know why that is exactly, because everybody's coming out with a vaccine and a vaccine for the vaccine and then a vaccine for the vaccine for the vaccine. And pretty soon we're going to have vaccines for vaccines for vaccines for vaccines. Or you go and you get more meds to take care of the side effects of the vaccine. So if you're confused, so am I. And right now, they're not doing too good. The healthcare sector breaking down to very important sector of the economy, 1/6. So yes, you have things like banks going up, you have oil companies going up. That's good. That's going to hold you up for a little while. But this is an important part of the economy is healthcare, and it's not doing too well. It's starting to curl over and go down, and semiconductors also are really close. This is sort of the last bastion of like technical speculative strength. Look at that. There's a rounded top. Those don't always work, but they work more often than not. This could be a top here. We'll see. American Express. Okay, here's another parabolic credit card company for you. Oh boy. Boeing. Now, Boeing's a little different, but look at this thing. Boeing all of a sudden has broken out. This is a Dow component. I brought you this because it's one of the most important Dow components. As a matter of fact, in the last month, Boeing has added more than 500 points to the Dow by itself because the Dow is a price-weighted index. In other words, the higher your prices, the more you actually are weighted in the Dow, which is unlike the other indexes, which are market cap weighted. So when you have, so that's why you'll never see Amazon in the Dow because it's a $3,000 stock. It would dominate the Dow, you know, because you do it by points. Boeing has high influence, as do all high-priced companies in the Dow, much more than the low-priced companies. That's why you don't tend to see super high-priced companies in there. You will not see those because then they make the index even worse than it already is, and it's not a great index. Trust me on that. Costco continues to, you know, this is a little bit of a snapback here, but this one behaved as we had predicted. This is one of the bad signs that continues to be bad, even though there will be snapbacks like this. And those are times to, you know, get out, but this is not showing anything. FedEx actually showing a little bit of strength here. So we're going to be cautious on this one. FedEx looked like it was going to break down. UPS looked like it was going to break down. They haven't yet. They haven't yet. So it's very important right now for us to not get too aggressive about the downside until, you know, there's a little more uniformity here. And there will be. There should be soon. But right now, I'm going to say, caution, you know, we may not yet have that. And here's another reason why. Another reason why is companies like Ford Motors, the old stodgy Ford Motor Company that's now going to sell all electric vehicles and make tons of money. And it's in a parabolic phase and it continues to make new highs. Probably because of all the stimulus. I wouldn't be surprised if you could walk in there with a bunch of those Hoot Loots that we're making. One hoot, we're going to make a 100 hoot dollar bill. We're going to make all kinds of stuff that you could walk in there and buy, you know, with that kind of stimulus, the car of your dreams. Hopefully you can. Goldman Sachs continues to go up. See, this is another company that is adding a bunch of points to the Dow because it's a $300 stock, and all of a sudden it's, you know, it's a dominant company in the Dow. So, you know, I don't know why it's going up this much. 100% in 6 months is a pretty good run for a company that's that big. General Motors too. Look at that new high. I'm showing you these because these are contrary to what I expressed last Wednesday. You know, you have to always look for contrary points of view. Okay, I began looking at the charts thinking, okay, this is going to be even weaker. No, actually, it's just not weaker, stronger. We'll see what happens subsequently, but right now, we don't look as bad as we looked a couple days ago because some of these charts look good. The problem is the interest rates will dominate the situation no matter what. If they keep going up, there's no way this is going to go up. No way. Same with the praying mantis company. That one broke out of a rounded top. It does happen. You can see it right there, and look at that, straight up. Sometimes these rounded tops don't work, sometimes, but most of the time they do. You have to be aware that they don't always work. It's always a game of odds. Everything's a game of odds. JP Morgan, again, parabolic. I don't, I don't know why. But buying a company when it's in a parabolic phase that's that high, it's just not right. You want to buy low, sell high, not buy high and pray it goes higher. And that's what a lot of people do. That's a greater fool theory. I've been the greater fool. I've looked for the greater fools. You can never find a greater fool when you need one, unfortunately. So when you need a greater fool to buy from you, they're never around. And you end up being the greater fool yourself. So be aware of that. I've certainly fallen victim to that. This is Merck. Merck is a big drug company in the Dow. It's broken down from what appears to be a fairly long rounded top pattern itself. And again, the reason I put it in here is because it's a very big company. It's an important company. It's a Dow company. Nordstrom's, I don't know what to say here. This is the only retailer that looks halfway decent. And all of a sudden you look at Friday's trading and the thing just like jumped, even though it was looking like it was in a rounded top. So, this is the only one that looks that way. So I tend to think that it's not really a good indicator, because it's the other companies are starting, they're all breaking down. The only one that isn't a little bit is Home Depot, but in general, retail's breaking down. So, we don't take, we're not going to put too much weight on that one. Just be aware of it. This is Verizon, another Dow company in and of itself, in a big rounded top pattern potentially. A lot of these companies are in the same pattern. So you got to be careful. Walmart, be careful. Walmart shoppers, here you go. And they're all the way, what you see here is Walmart breaking down, and it's a very important Dow company and retailer and online retailer. So ExxonMobil going through the roof, as are oil companies right here. This is, ExxonMobil. Exxon used to be the dominant company in the United States. It used to have the highest market value, and all of a sudden it's starting to act, now it's with Mobil, and this thing could end up, going a lot higher. Maybe. We'll see, because again, I've talked about shale oil and the competition from shale, and I'm not sure that that won't come on stream soon. Target, another retailer that doesn't look so good. And so when you look at stuff like Target and some of the other ones, I put more emphasis on this and Walmart than I do on Nordstrom's, and I kind of wonder about it. And then finally UPS, it looks like actually like it's breaking up from around the top. So again, this is the kind of stuff that you have to be aware of. You have to factor into your thinking cap, because it means you might have gotten your thesis wrong. And so I'm telling you right now that while I still believe that interest rates will be the dominant theme, right now these companies are showing a little bit of life, and so I'm exercising some caution, as I think you should too. And then finally, this is a spec, okay? This is a spec. I like this spec because of the way it sets up. This is the ProShares Ultra Short QQQ, which is a negative inverse ETF for the NASDAQ. Now this is one where you could, it's right in between a sell zone and a buy zone. So you could, with a, you sell under 26 or you buy, over 28. And basically that gives you a perfect opportunity, to make a lot of money if the NASDAQ really takes a tumble, which I think it will, okay? And, cut your losses pretty quickly without losing too much, in case I'm wrong, which I usually am. So I definitely want you to be aware of that fact. But in any event, that's our last chart for the day. Today's March 13th, money, money, money. Please like and subscribe. We'd love you to death. And if you see some of our earlier shows, we'd love to have you see some of those, because we've been talking about this for months on end. In any event, this is Hoot Loot signing off.